Justin, hi. So we're moving on to our second video, due diligence today. We've talked about heads of terms, so we're now at the sort of second, big step in an M&A transaction. What does the due diligence phase mean for you and for your clients, and what's your sort of take on it in perspective on DD generally?
So, due diligence is, the way I see this or try to explain it to clients, it's a period of examination. It's where the buyer will want to examine the seller's business, from a legal point of view, from an accounting point of view, from a tax point of view, from an environmental point of view. Yeah. Could be an IT point of view, cybersecurity point of view, but it's effectively a deal has been agreed subject to the buyer checking the seller's business. But I think the interesting thing that I always take from this, 10 plus years downstream of guiding sellers, is it is a period of examination that I think that a seller has never experienced before.
I'd agree.
And something is, I reflected, and I said this to a client recently, or a prospective client, I said I realise now it's actually easy to say the words, this is an extensive examination, and that actually you're going to need to dedicate a period of your life to answering those questions, or having a team of people and supervising them answering those questions. It's different to saying the words than having the experience, because actually X number of transactions downstream, you can see the period that once the due diligence starts, within weeks, the seller goes from zero to stressed in a heartbeat. And it's as if they never expected it. And you say, well, we talked about this extensively, 6-9 months upstream. I don't know if you think the same or have the same experience.
Yeah, I think that's right. I think it's difficult for a seller, typically in an SME, that seller is also running the business. And the due diligence phase might take 4-6 weeks, it might be longer. And a seller won't typically be anticipating the extensive nature of the questions from the buyer. I mean, a typical due diligence questionnaire, as you know, could be 20 pages, could be more. There could be the same again in respect of property, the same again in respect of accounting and tax. The buyer's not necessarily looking for problems, deliberately going to try and find an issue, but the intention of the due diligence is to, suss out what might be missing or, what's not been done in the correct way. For a seller who's owned and run a business for 20 years or more, some of the questions they might sort of immediately think, well, I don't know where that is, or I'm sure we've done it, but where is it? And it is just time consuming going away and collating all of the supporting documents. It's not a case of just answering the questions. You have to substantiate your answers, provide all your insurance documents, all of your employment documents, all of your statutory books and records, your register of members, your register of share allotments. A lot of owners of SMEs may not know what those are, or indeed where they are. They are a legal requirement, but before you get into a sale process, you may not have any real need to be looking at those and checking on them on a regular basis. So the due diligence process, as you say, is extensive. There's a lot of people involved, and it's simply time consuming.
It is, and it's normally, so with sellers, I always advise, say, listen, once we've got heads of terms signed and you're going into due diligence, you will need an accounting / tax support. Yep. You cannot do this on your own. You might have somebody internally that's a qualified tax attorney or whatever it might be, or you might have a team of people, but often it's not, it's outsourced. It's the same as you need a legal team in place that are very experienced in corporate M&A transactions to support you. Yeah. Don't use your local solicitor for the house conveyancing and so on. But I think for me, the one thing that really jumps out is the period of due diligence typically can catch sellers out. And I can think of several areas where I see a repetitive pattern that comes up. And it's, I liken it, because we deal with SMEs, businesses turning over a few million up to 20, 30, 40, 50 million, whatever the number is. Yeah. The smaller businesses, typically 5, 10 million turnover, inevitably have very light internal financial systems. And when I say that, they can be very successful businesses, and it's not a critique from that sense, but they can run their business and they get their annual accounts done by the local accountant. They might have light IT systems in the business. Yeah. And, few checks and balances in a very sort of granular level. that you might find in a much bigger company. And the reason that I sort of highlight that is because I see this as a repetitive pattern that typically the seller and the corporate finance firm, could be us, could be somebody else, might be somebody else, will have presented financial data to the buyers. The buyers will have said, okay, that's great, we'll sign up a deal according to the data you provided, but then they'll want to come and check it in due diligence. And this all comes down to the quality of the internal systems in the business to be able to generate repetitive, consistent, accurate financial data while the company's on the move. Not just at year end, this is month by month. And that's where I see things falling over quite a lot. Actually.
It's about resource, isn't it? And it may not make sense in normal times, pre-transaction times, to have that expensive financial resource on tap at all times in an SME, because you don't need that specialist bespoke reporting each and every month on some particular nuance that the buyer wants to know about. Those services and those skills can be added in for transactional purposes. You can find excellent local accountants, corporate finance advisors who can assist with that process. And it's important, I think, to not let the DD process overwhelm a seller and recognise what you can and what you can't do. As you say, there may be certain things which can be handled internally. If you've got a good HR team, you can probably deal with all of your employment due diligence. If you have got a, particularly scrutineering a buyer who wants to know about the intricacies of your tax arrangements for the last 3 years with some particularly taxing questions, it may be that your internal resource is not quite up to that, and that's fine. Doesn't mean that person or that team you've got in the business is not operating as it should. It just means that you now need a different level of resource, which may be better served by an external advisor. Absolutely. So it's recognising that, I think.
It is recognising that, and I think this, as the years roll on, in terms of sort of helping and guiding business owners to saying, well, listen, the due diligence process is extensive. The buyer is probably, not always, but probably going to look at the business in a level of detail that you as an owner have never looked at.
Yeah, that's right.
They're just simply going to analyse your financial data in a way that you probably just don't look at when you're running the business. So the question is, I suppose, in my mind is, what advice would you give a business owner? Would you say, listen, just, sell it and wait for the due diligence to happen and hope for the best? This is as if we're down the pub and we had somebody come and said, I'm thinking of selling my business. What advice would we give? Would we say, do a dummy due diligence up front? Do the process before you go to market? Flush it out? Or would you say, do something in between, or just do nothing? What do you think?
You shouldn't do nothing. I mean, the more you can do to get your house in order, the easier it's going to make your life. If you are rushing around trying to solve issues which have arisen in due diligence whilst you're in the middle of a transaction, that's going to make life very challenging. You're trying to run your business, you're trying to negotiate the key commercial terms for the sale of your business, and you're trying to address issues which have arisen in due diligence, which might be historic share issues. It might be contracts have lapsed or IP has lapsed. So you're trying to do too many things. If pre your head stage, you have had a sort of dummy due diligence exercise where you've looked at some of that stuff in advance, you've hopefully spotted the issues in advance and had an opportunity to rectify them. So I think in terms of time and stress management, the more you can do early on, the easier you will make your life. So, we see people sometimes who set up or ask us to help them set up dummy data rooms, and that might be, some service online where they start depositing key contracts, employment contracts, insurance documents, and they start building up those folders so that they know they've got everything well organised in a great place. When the buyer says, well, we need to see all of that, it's a case of granting access to the data room, and you've really streamlined that process. So there's definitely things that can be done to make life easier, and that's what people need to be aiming to do, really.
I think that's I would actually sort of amplify that a bit, actually. No, I would, because I think it's, the business owners typically have run the businesses for decades.
But they've run it for themselves, haven't they? And for their own, they're not running it for the buyer. So they're,
correct.
They're not doing all the things that a buyer would have necessarily expected.
It's right, but it's kind of like, if you, I don't want to profile a typical seller, but age profile 50 to 75, perhaps.
Maybe, yeah.
Is the bell curve maybe the 80%?
On the retirement sales,
yeah. You know, coming to the end of their, or the autumn period of their career, saying, okay, what to do with this, and of course having often a very valuable asset, you know, potentially hugely valuable asset, a life-defining value change asset, and then, you know, there's a window, and the thing is, selling a business doesn't take 5 minutes; it can take up to a year or more. So if you're saying, well, it all comes to a head in that due diligence period. And often as not is, of course, the emotions tend to get high because, of course, in the heads of terms might be a number that says, here's 10 million quid for your business. You know, and the owner might be going, it's fantastic. And of course, in the owner's mind, you know, they've already written the check out. They've not talked about this, but they've talked about it with a partner, the family, they've gone with the yacht, the second home. And of course, it's in their mind, it's all happening.
Yeah.
And then the due diligence happens, and of course, is that then the objective teams from the buyer turn up, you know, clinical, looking at the data. So my view is the reason I'm amplifying it a little bit is because actually I think it's a period where you can't afford not to get it wrong.
Yeah.
If it goes wrong, it potentially resets the whole process either back to a renegotiation or deals off the table. So I would argue that if I was down the pub and somebody said to me, listen, I've got a decent sized business and I'm lining up for an exit, I'd say do the dummy due diligence, don't do it yourself.
I think it's about perspective, actually, because I think that someone who's owned a business and run a business for 20 years in a way which they're happy with it, stock is a good example. You know, over that 20 years, you may have built up a really decent level, useful level of stock, which from your perspective is fine and is healthy for the business. The buyer may come in and say, well, actually, that stock is not turning over fast enough. We therefore are going to have an independent stock due diligence, and we're going to write down the value in your slow moving or obsolete stock. Well, the seller's going to say, well, no, I don't accept that. You know, I think that, you know, that's a genuine value to the business, and the buyer's going to have a different perspective. So you've then got to balance those perspectives in some way to resolve that issue. But, you know, how up to date is your stock reporting pre the buyer starting their due diligence? If you actually got a good handle on your stock, can you actually make your argument in advance? Say, well, this is why we do hold that historic stock. It's justifiable, it's valuable, etc., etc. So yeah, happy to go along with your amplification of doing the DD first. So that's probably due diligence in a nutshell, really, unless you've got anything to...
I think that's it. I think we covered it quite nicely.
Excellent.
There's always more, but...
Yeah. Good talking to you.
Likewise.